Thanks for visiting my channel. For anyone new to this channel, my name is Tanveer Chowdhury. I'm a certified financial planner and real estate investor. I make educational videos regarding wealth building, financial planning, and real estate investing. Topic of today's video is RRSP withdrawal. This is part 3 of the RRSP series. You can watch part 1 and part 2 of the RRSP series in the link above. Part 4 of the RRSP series is coming out next week, which is about RRSP mortgages. Before we get started, I'd like to ask you a favor. If you learn at least one new thing from this channel, please help me out by subscribing to this channel so more financially savvy people like you can benefit from this information. Let's get started. There are basically 7 rules of RRSP withdrawals. Rule number 1, there is a common misconception that you cannot withdraw RRSP funds before retirement. That's not true. In fact, you can withdraw RRSP funds anytime before retirement. You just have to pay the tax and add the withdrawal amount to your income for that year. Rule number 2, when you withdraw funds from RRSP before maturity, you must pay the withholding tax, which your financial institution must deduct from the proceed and remit it to CRA on your behalf. Withholding taxes are calculated based on amount of withdrawal and your province of residence. Your total RRSP withdrawal in the calendar year must be reported on your tax return as income for that year. If you're planning on withdrawing funds from RRSP later in the calendar year, it's better to wait until after January 1st of the following year as opposed to withdrawing funds before December 31st of the current year to defer the taxes until the next calendar year. You should also consider withdrawing funds from RRSP in $5,000 increments so you pay only 10% withholding tax and defer the remaining taxes until you file your return. Let me give you an example. If you withdraw $20,000 in $5,000 increments, you'll pay $500 withholding tax per transaction for the total of $2,000 withholding tax for the 4 transactions. But if you withdraw $20,000 from your RRSP in one transaction, you'll pay $4,000 in withholding tax, which is 20% of $20,000 total withdrawal, as opposed to 5% withholding tax if you withdraw in $5,000 increments. This way, by simply withdrawing in $5,000 increments, you are able to meet your immediate cash need and defer the taxes until you file your tax return. At that point, you can decide to contribute back some of the amount withdrawn to neutralize the tax payable on withdrawal if you have the contribution room. Rule number 3, when you withdraw funds from RRSP before retirement, you permanently lose the contribution room, unlike TFSA. Also, if you withdraw funds from RRSP in your early working years, you lose out the tax-deferred compounding of potentially 20 to 30 years. You might not realize the effect of losing contribution room and tax-free compounding in your early income years, but you will surely realize later in your career. When you are in the high income years, you need RRSP room the most to either beef up your retirement nest egg or offset income taxes from bonuses, severance packages, or selling investments. Rule number 4 is the first-time home buyer plan. When you withdraw funds from your RRSP under the first-time home buyer plan, you can withdraw $35,000 tax-free per spouse without paying any withholding tax. You are considered first-time home buyer if in the previous 4-year period you did not occupy a home which you or your spouse owned, and you must have a written agreement to buy or build a qualifying home that you intend to occupy as a principal place of residence within 1 year. Repayments begin 2 years after you withdraw the funds, and you have 15 years to complete the repayment to your own RRSP. Any year you don't make home buyer plan repayment to your RRSP, it gets added to your income for that year. I'll be making dedicated video on first time home buyer plan and newly introduced first home savings plan in the month of March. Rule number 5 is lifelong learning plan. When you withdraw funds from your RRSP under the lifelong learning plan, you or your spouse must enroll on full-time basis in qualifying educational program at a designated educational institution. You cannot participate in lifelong learning plan to finance your children's education. Under the lifelong learning plan, you can withdraw up to $10,000 tax-free from your RRSP in a calendar year without paying the withholding tax. Funds have to be in your RRSP account for 90 days. Your spouse can also withdraw up to $10,000 tax-free from their RRSP in the same year you do. You can withdraw funds from your RRSP under the Lifelong Learning Plan until the January of the 4th calendar year after the year you made your first RRSP withdrawal under the Lifelong Learning Plan. You cannot withdraw more than $20,000 in total from your RRSP under the Lifelong Learning Plan, where you have to repay 1/10 of the amount you withdrew under the Lifelong Learning Plan until the balance is zero. Any year you don't make repayment back to your RRSP under the Lifelong Learning Plan, it gets added to your income for that year, same as first-time homebuyer plan. Rule number 6 is to withdraw funds from your RRSP before maturity using RRSP meltdown strategy. There are few ways to melt down your RRSP before retirement. I have separate video on RRSP meltdown strategies. You can watch that video right here. Rule number 7 is to withdraw funds from your RRSP after maturity, and you have 3 options. Option number 1 is to withdraw all the funds from your RRSP in lump sum, but withdrawn amount will be subject to withholding tax. There is 10% withholding tax on the first $5,000 of RRSP withdrawals. There is 20% withholding tax from $5,000 to $15,000 of RRSP withdrawals. And there is 30% withholding tax on any withdrawals above $15,000. Final income tax will be calculated from all income sources when you file your tax return. Option number 2 is to convert your RRSP to RIF, or Registered Retirement Income Fund, as early as age 55 or as late as December 31st of the year you turn 71. RIF gives you steady flow of retirement income with the minimum amount must be withdrawn each year. When converting from RRSP to RIF, you must make minimum annual withdrawal from your RIF. Financial institution which holds your RIF will calculate the minimum amount based on your age at the beginning of each year. RIF minimum withdrawal rate is 4% of the amount deposited at age 65 and 5% of the amount deposited at age 70. These minimum RIF withdrawal must be included in your taxable income each year. There is no withholding tax on the minimum withdrawal amount, but any amount above the minimum withdrawal will be subject to withholding tax. Third option at RRSP maturity is to convert your RRSP to annuity, either life annuity, which provides guaranteed income for life, or term certain annuity, which provides guaranteed income for specified period of time. You purchase annuity from life insurance companies either by depositing the lump sum amount or depositing multiple payments over time. There is no withholding tax on the amount you use to purchase annuity, but you may have to pay tax on the income when you start receiving payments from annuity. That's all for this video. Please remember to watch part 4 of the RRSP series about RRSP mortgages coming out next week. If you think information like this can benefit someone, please share this video. Also like, comment below, and consider subscribing. Thanks for watching, and see you in the next video.